Michael, thank you for joining us. Today the bank released its first half results and cash earnings were up over the half, although still signs of pressure in some parts of the business. How should we interpret these results?
Yeah, look, I'd start off by saying I'm really pleased with this half's results. When we look at it, there's a lot of factors at play. So probably if I just step through how we look at it. Firstly, overall, core earnings were up 6%. Core earnings is our measure of how the underlying performance of the business is going, so that was pleasing. And when we look at net interest income, interest income was down a bit, and that reflects the pressure we've seen on margins, particularly from the stiff competition in the mortgage business, both in Australia and New Zealand. Non-interest income was also down a bit, but that's really a reflection of lower income in our wealth businesses, which, as we know, we've decided to exit. When we stand back though, costs were down 10%, and that's a really pleasing aspect of the result.
You mentioned the good progress on cost reduction. I wonder if you could give us some context around that 8 billion cost base target you've got for 2024. How are you tracking on that?
Yeah, as we've said, we're committed to the $8 billion cost target. We've had in place now for about 18 months a cost reset program, which provides us with a really clear pathway to that $8 billion. And so what we saw in this half was that the plans that we had put in place in the prior years are now underway and are delivering. And so that's delivered starting to deliver a simpler organisation and more efficient. And so that's now playing through the results.
In terms of the ongoing pressure you're seeing in margins, what can you do to address that?
Yeah, it's an interesting point. You know, the mortgage market, both in Australia and New Zealand, has been very competitive for a long time. What we've seen though, particularly over the last 2 or 3 years, is a very low rate environment. So when we've got fierce competition, low interest rates, there's not much room for major banks like ourselves to go. And so, you know, we've taken the position that we needed to be competitive for our customers in the broader market, and that's just meant a lower margin overall. Now, as we see the economy coming out of COVID, starting to grow, and economic activity being solid, we're starting to see interest rates rise. So that helps us from an overall economic perspective, but it will still remain competitive.
And in terms of credit quality, there was some improvement over the half, but of course, as you mentioned, we're entering a tougher environment with the rates going up. How do you see that playing out? Do you see any early signs of stress emerging?
Yeah, it's a good question. Look, all the credit metrics that we measure are performing well, so they perform better again this half. But as you said, there's a lot of uncertainty. We've got the war in Ukraine, and that's impacting supply chains and driving up inflation a bit. We've seen the floods in Queensland and New South Wales, and that's putting stress on parts of our customer base. And we're just seeing general, a bit of general uncertainty with the election and those sorts of things. So that plays through. But, as I said, with better economic growth that we're seeing, that will underpin and support our customers and the economy going forward.
And turning to capital, you've set a new target range for that. What's behind that?
Yeah, so capital again is a pleasing aspect of the result. Our capital's is in a good position. We were able to return about $5.5 billion to shareholders this half, but that's also allowed us to set a capital range which is in line with what APRA is expecting and also the new Basel III rules from the 1st of January. So that was really what was behind it, and it gives us some management buffer to allow us to pay a dividend going forward in future periods.
And I'm sure shareholders will be cheered to see the dividend going up. Is there more to come on that front?
Oh, look, we're very focused on delivering improved returns to shareholders. We saw earnings per share up to 85.4 cents in a half, which is good, and it's certainly a focus of ours to continue to drive earnings and returns going forward.
And how would you respond to people who maybe say you're being a little bit cautious on the payout ratio?
Oh yeah, we've told the market that we've got a dividend payout ratio of 65% to 75%. This half we've declared a 61 cent per share dividend. That's around 69-70%, so it's at the top end of the range. But as I said, there's still some uncertainty in the economy, in the global environment. So we're just being a little bit, we've got an eye to that, but we think where we've settled the dividend for the half is quite good.
And more broadly, Michael, how are you feeling about the prospects for the economy in the second half of the year, given the headwinds that we know we're faced with right now?
I'm quite confident about the economic outlook. I think there are a number of factors at play that go both ways, but I think on balance, the better economic growth that we're seeing, lower unemployment and general confidence in the community will offset some of the headwinds that we're seeing from higher interest rates and inflation.